This is Debbie Carlson with Kitco News, and I'm at the New York Hard Assets Conference. We had a chance to talk with Dr. Martin Murenbeeld of Dundee Wealth Economics. He is their chief economist. Here's what he had to say. Thank you for being with us. One of the questions I wanted to start with today is, you're bullish on both equities and gold, and normally that's not considered two markets to be bullish on. Can you tell me a little bit about your thoughts on these two?
Well, it really depends a little bit on liquidity. And if there is enough liquidity in the system, and liquidity here refers to money supply that is either being printed or in other ways generated by central banks, then the liquidity go to seek a home, and one of the homes would be equity markets. So take a more concrete example. The Fed buys Treasury bonds. It pushes up the price of bonds, pushes down the yield on the bonds, and that encourages investors like you and I to turn to other assets, and one of those assets would be equities. And maybe in your case it's equities, maybe in my case it's gold. So liquidity tends to buoy both. Okay, and we determine that on the basis of three scenarios. One, which is a negative scenario, we force it to be negative. We take all the bad assumptions, exit strategies, that sort of thing, that we think tend to push the price of gold lower. On the other side, we take a very bullish scenario where everything goes gold's way, and we put probabilities on that, and we have sort of a baseline. When we add all that up, we come to a number of around 15 as an average for the year, and that average will rise next year. The average is likely to be something in the neighborhood of 1675 on present calculations. Well, we've tried in years past to sort of come up with some kind of a modeling process for silver, similar to what we have in gold. And the problem there is that there's a large component in the silver demand that is purely industrial. So it's not a monetary kind of demand. At the margins, there's some monetary demand. And that, of course, is what has been exploding in the last few years. So having said that, we don't have a good feeling about where the price of silver would go. But the one thing that we have come to the conclusion, running models on silver relative to gold and so forth, that silver is a very high beta gold. So you literally have to have a steel stomach to be heavily invested in silver. I'm not an inflationist with respect to the U.S. and Canada. We've not seen really significant enough growth in the monetary aggregates called M1 and M2 to make me particularly worried about inflation. Now, understand that M1 and M2 is quite different from the monetary base. Okay, the monetary base has blown up, but it has blown up with the express purpose of trying to push M1 and M2 higher. Now, this gets a little bit technical, but the way we economists talk about it, there's a multiplier between the monetary base and M1 and M2. That multiplier has collapsed. And the reason for that is varied. It has to do with people willingness to borrow. It has to do with banks' willingness to lend. Just how the banks want to run their portfolio. When the Fed buys Treasury bonds, it puts the money into the banking system. The banking system would normally lend it out again, but this time what the banks do is they put the money straight back into excess reserves. So you get a blow up in the monetary base, but you get really no corresponding blow up in M1 and M2. Now, it's important to understand because the Fed is doing all of this precisely because one of the worst things that can happen, and as Milton Friedman made famous, is you can't have the money supply collapse. You can't allow M1 and M2 to turn negative for significant periods of time, because then you're going to toy with the depression. Mm-hmm. So I fully agree with what Bernanke is doing, and which is quite different now from what, for example, China is doing. China has massive growth in M1 and M2, much higher than what the economy would normally absorb. And so I'm also inclined to think that inflation rates in China are somewhat understated. But China has a serious inflation problem that is purely monetary driven. The U.S. does not have that kind of problem.